What's going to happen to our spring property markets with a pandemic, with lockdowns, with closed borders, cancelled events, falling confidence, even talk of a double-dip recession? That's what I'm going to discuss in today's Property Insider video with Dr. Andrew Wilson. We're also going to talk about what's happening to wages growth and the latest unemployment figures and what this means for interest rates, which clearly have implications for our property markets. If you want to keep up to date with our regular Property Insider videos, why not subscribe to this YouTube channel and click the little bell icon so we can keep you up to date every time a new episode comes out. A pandemic, lockdowns, closed borders, cancelled events, falling confidence, the talk of a double-dip recession. The list goes on and on. It seems like there's no good news anywhere. Now, there's little doubt this is serious, and I don't want to make light of coronavirus, but I'm of the opinion that when we look at this in a couple of years' time, its impact on the property markets will ultimately be temporary. In the words of the famous allegory, this too shall pass. For mine, it's always been the property fundamentals that really matter. Things that will really matter over the long term for our housing markets include demographics, the availability of finance and the cost of finance, interest rates, taxation, regulation, affordability, consumer confidence, that's very important, and of course supply and demand. In the long term, none of these factors are likely to be substantially altered by the current virus wave and all the fear that we're currently experiencing. However, in the short term, lockdowns around Australia and the effects they're having on business and consumer confidence, including things like the ability to inspect properties, to sell properties, that's clearly going to have an impact on our property markets. And these are some of the matters I wanted to discuss in this week's Property Insider Chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes, good morning, Michael. I think that, as you said, all these things pass eventually and the human race is still running, and we'll continue to prove ourselves to be resilient and robust. And perhaps we've scared ourselves a little bit too much through this event, but that's a whole other story. But yes, onwards and upwards. And I think there is a light at the end of the tunnel. It's just still a little way off at the moment.
Sure. Well, there is a light. This time last year, we weren't sure, but now we know vaccines give a degree of success. And once we get it, whether it's 70%, 80%, we know that there is going to be some hope there. But in the short term, Andrew, we're only about 2 weeks away from the beginning of the spring selling season. And that's usually when there are more sales, more listings, buyers and sellers are out in force. What do you think is going to happen this time round with half Australia in lockdown, Andrew?
Well, we've just gone down a level in terms of volumes, Michael, and that's because basically the physical restrictions are impeding the normal activity of buyers and sellers. It's the physical restrictions, nothing to do with lack of confidence in the market itself. As you suggested, the underlying drivers remain quite firm. We still have positive affordability in all our housing markets. That's why prices continue to rise. And the big picture is, even though we have focused on those very strong results this year, that house prices across the board, if we go back to the previous cyclical point, particularly Melbourne and Sydney, which was in the middle and end of 2017, all capital city markets, with the exception of Perth, have actually averaged around about 4% per annum since then. And considering we've had over a 1% fall in interest rates over the last 4 years, mortgage rates, and also a 6 to 7% increase in incomes, that's why we're able to pay more in the shorter term. We're just catching up where we would have been without all these interruptions we've had over the last 4 years. And this is another interruption, Michael. And once it's behind us, as it will be, we will catch up again where we should be and head into a brighter future in terms of less of the roller coaster ride, notwithstanding, let's hope we don't have any more lockdowns. But the spring selling season will certainly, as lockdowns persist, in Melbourne and Sydney, will be a flatter event. But nonetheless, those properties, particularly in Sydney, that are still on the market are finding buyers very, very quickly at the moment, Michael. We've had some big results on the weekend again in Sydney. Buyers are still chomping at the bit to secure property. It's just obviously difficult for the sellers to bring their properties into the marketplace. And Melbourne's an exception because you still can't inspect properties in Melbourne, unlike Sydney, where you can continue to inspect or conduct one-on-one inspections under obviously controlled circumstances. And that means the housing market there is continuing to tick over, but in Melbourne it is pause mode again.
Well, that was reflected in this weekend's auction results, which really were a tale of two cities, weren't they?
Yes, Michael. Sydney recorded another very strong result, 86% clearance rate. That's the highest clearance rate since those crazy record days back in March and into April when we were getting 90% clearance rates. And the trend is clearly upwards now for the Sydney auction market, weekend auction market. But if we look closely, Michael, we can see that the numbers are very low in terms of the properties being offered for auction at the moment. Just over 400 properties reported listed in Sydney at the weekend. And this, of course, reflects that lack of capacity for sellers to get into the market. And because they have more skin in the game, perhaps they're a little bit more reticent to engage the marketplace until there's a bit more clear air. But certainly properties that are available for sale in Sydney are selling quickly. In fact, days on market is actually falling in Sydney at the moment compared to last month. And that reflects, again, the strong appetite for buyers at the moment for available property. But there's no doubt that listing numbers are falling, and we shouldn't be surprised at that. In Melbourne, we had another reasonable clearance rate at in the 60s, obviously lower than where we've been prior to shutdown. But again, we had actually high numbers of listings, but we've got to understand that those auction numbers reflect decisions that were made prior to lockdown. When we look closer at the numbers, Michael, we can see there was a massive withdrawal number of people withdrawing their auctions on Saturday. And of course, they were the ones that had been booked in a month or more ago. We had over 50% of reported auctions were actually withdrawn, which is nearly a record level. We really do have to go back to April last year to see higher levels of withdrawals. And of course, that is responsible for the lower clearance rate, because with all those withdrawals are still counted part of the mix. So therefore that pushes clearance rates downwards. But if we distribute withdrawals on a normal level, which we were used to, we actually had a clearance rate pushing 80% again in Melbourne. So those properties that are available for sale in Melbourne, similar to Sydney, are certainly still selling. Although the environment in Melbourne is much more difficult because you don't have the capacity for physical inspections. And I know the industry down there, and that's no surprise, is a little bit peeved that they don't have the same capacity to conduct their business in a controlled and safe environment as their colleagues in Sydney do. But the other capital city markets kept on keeping on strong results, listing numbers a little down, but certainly Adelaide and Brisbane aren't as affected by lockdown restrictions as Melbourne and Sydney are, particularly Melbourne is. So they're continuing to chug along. But no doubt, Michael, as you said before, the fundamentals are clearly still positive for our housing markets. It's only the restrictions that are impeding the volume that's coming through the marketplace at the moment.
Over the last week, there's been some new figures coming out on wages growth and also on unemployment. And at first glance, it actually looked pretty good. Wages have gone up over the year and unemployment has dropped. But if you dig deeper into the figures, Andrew, you see a slightly different picture, don't you?
Yeah, we had a remarkable number for the unemployment rate, Michael, down to 4.6%. These are 10-year lows, these numbers, and it's not out of the blue completely because we had a 4.9% unemployment rate over June. So the July numbers are very strong again. But as you said, Michael, when we look a little deeper into the numbers, they're not quite as bright as they would appear to be. The numbers, the national unemployment rate was clearly impacted by Australia's biggest economy, New South Wales. We saw a sharp fall in the participation rate in New South Wales. That always acts, all things being equal, to push down the unemployment rate, because what that means is there's actually fewer people from the population actually engaged in the labour market. And that meant, of course, we had a sharp fall in the unemployment rate, as was factored in clearly by that fall in the participation rate in New South Wales. And of course, no surprise, New South Wales unemployment rate, even with that falling participation rate, its unemployment rate went up. And that's the impact clearly of COVID over the last 6 weeks on the New South Wales economy, with people being unable to work and people pulling themselves out of the actual workforce. But overall, the other states are doing quite well, and it has been a remarkable recovery nonetheless, but it will be one that is impacted by COVID lockdowns in Melbourne and Sydney. And of course, New South Wales is the biggest economy in the country. Not quite sure we'll get those back-to-back negative growth numbers to give us the official recession. Perhaps encouragingly, the usual clickbaiters are staying away from crazy predictions of doom and gloom in our economy, but certainly it will have an impact going forward. Now, the other point that which we have pointed out before, Michael, is hours worked is actually quite low again. And
Yes.
Even though we've had a low unemployment rate, people really haven't got the level of hours that they are working that they've had previously. So it's a good headline number. But when we look a little deeper, there are signs of coming issues, which would result in higher unemployment rates or higher underemployment rates and lower levels of hours worked. But we shouldn't be surprised at this, given the impact of lockdowns.
Of course, this means there's no interest rate rise anywhere near in sight, is there?
No, that's right. And we had some other important data out, Michael, which we really should have had more focus on prior to lockdown. There's been a lot of really crazy scuttlebutt about the prospect of higher interest rates next year from some sources, which was just nonsense. We've had a bounce back in inflation, which was eminently predictable given how inflation was squashed last year during lockdown for a variety of reasons. We've discussed that. But the other end of the equation is certainly incomes. It's not just about inflation. I'm not sure where a lot of these economists got their degrees from. They've got to get their head out of first-year economics textbooks because it's a little deeper than that, guys, but perhaps not really deeper than that, because we do need to watch incomes growth. That is the key to higher interest rates. And of course, we had the wage index data out last week, Michael, for the June quarter. And again, a very disappointing result in terms of wages growth, even though annual wages growth has pushed up to 1.7%, which is very low. It does include what was basically zero wages growth in the June and September quarters last year. So that will, going forward with current trends, will start to actually go backwards again. But I think so wages growth is non-existent, Michael. We have to have wages growth before we even thought about having higher interest rates. They have to move together, people. We have to have higher inflation and higher incomes working together as they did in the 70s and later in other periods of strong economic growth to have to work with higher interest rates to quell demand. Now, the problem is if we get higher inflation, Michael, which seems to be the key focus, and let's face it, a lot of this is clickbait nonsense that promotes higher rates, but we have to have higher incomes, because if we get higher interest rates on the basis of higher inflation, Michael, and we have low incomes growth, we're going to get even lower real incomes growth. And that's the story at the moment, Michael. If we look at real incomes growth at the moment, it's just at 0.1% per annum, which is as low as we've ever been. And that is really not the environment to have to be considering higher interest rates. That would only take more money out of people's pockets when their real wages, and that would create falling real wages, and that'd be the last thing the Reserve Bank would ever be thinking of, because it would really crack the economy.
Well, following on from what you said before, currently about 30%, 31% of employees are working part-time. So there's still quite some capacity. So even though there was that 1.7% wages growth for those working full-time, 2/3 of people are, a third aren't. So lots of capacity before wages would even start rising.
That's right, Michael. And there's some fundamental underlying issues here. We've seen in advanced Western economies the inability to push wages up through since the GFC. Despite pushing interest rates down to zero, it has had no effect on lifting wages over the longer term. And this is a conundrum because it really has taken monetary policy sort of off the shelf or off the cards as being the traditional driver of increasing prosperity. And what are the reasons? Perhaps it's just the cycle of economics, macroeconomics finally working its way downwards, with monetary policy losing its energy over the decades, which is really eminently predictable if you think about how monetary policy has been used. Or other factors that are keeping wages growth low, technological change, immigration, changes to the nature of workplaces. All these factors also create more or less demand for traditional labour as we know it, regardless of the current COVID environment, Michael. That low wages growth number, which was a surprise to the commentators who were predicting higher, gee whiz, how often can they get it wrong? The level of real wages growth now is very low and of a concern going forward. And let's face it, Michael, if we had interest rates to cut, we would be cutting them with abandon at the moment.
Oh, clearly, if the Reserve Bank could, it would. I think what they're looking for is to get as many people as possible into full-time employment,
Yeah.
to raise wages for everybody, especially the low-income earners, because there has been a disparity of those people whose wages have gone up and a lot who didn't. And I guess over the long term, we'd like to shift more low-income workers into middle-income employment by strengthening the construction industry, the manufacturing industry. That's what the government's wanting. We're not wanting the big disparity between the high wages income earners who are doing well and the average Australian who's currently suffering from COVID, not having jobs, not being able to work full time. That's an issue.
Yeah, we don't want to go down the American road, Michael, where there's those huge disparities between top and bottom. We're not that sort of a society. We want to take the middle road, and that's what we traditionally do. We support those that are marginalised for whatever reason at the bottom end, and we nurture the middle. And we say good luck and pat on the back to those that do well at the top.
We spoke a bit earlier on about auction listing numbers decreasing, and that's normal. You can understand people don't want to pop their properties onto the market when it's difficult to inspect or impossible to inspect in Melbourne. But Andrew, what's happening with listings in general around Australia?
Well, not surprisingly, Michael, listings have fallen quite sharply since shutdown, particularly in Sydney, of course, but national listing numbers are down. It tends to be a roller coaster ride in Melbourne when we do look at listings changes. Obviously, lockdown means fewer listings, and when lockdown stops, we get a rush into the market with people who have been postponing their selling decisions coming back in. We can see the national listings change compared to last year, which I think is an interesting graphic. It shows us that we're not actually below where we were a year ago in previous lockdown periods. We've actually risen compared to a year ago. We've got to understand, Michael, that a year ago Melbourne was coming into the real depths of its lockdown period. So even though we've fallen away, as we can see with those numbers falling since lockdown 6 weeks ago, total listing numbers nationally, we're still tracking above where we were nationally a year ago, so not quite as severe. And when we look at the weekly numbers, they've fallen again, down around about 16% since the lockdowns, both in Melbourne and Sydney, occurred. So fewer listings, Michael, no surprise there. But as we were discussing previously, the listings that are there are still of very strong interest to buyers out there. And we're actually seeing days on market falling, which is quite interesting in Sydney. And prices are continuing to rise. It's just that there's not a lot of choices out there. And of course, that's the old story of supply and demand, isn't it, Michael? When you've got plenty of demand and supply is waning, typically you get higher prices. But what we do know, just to finish up, Michael, is that once our lockdown restrictions ease, we do tend to get a surge in listings, particularly in Melbourne, coming back into the market.
Well, as we started at the beginning of our chat, this too shall pass. We'll be back each week, though, to give our thoughts and our commentary. Thanks for your time, Andrew.
Yeah, thanks very much, Michael.